Hey everyone, thanks for joining today. We will be recording the session and we will publish it on my YouTube channel. So if you feel that you don't want to be don't want to be to be on this video, so you just write your questions in the comment section. So my name is Denis Kalyshkin. I am the co-founder of Space Ambition and also have a separate product called Ask VC where I share my wisdom about venture capital and startups. And today I decided to do a lecture for you on the topic of what are like typical mistakes founders do. So it will take us about 30 minutes for the lecture. And later I will answer to your question. So, for the last 12 years, I've been a principal at New York Venture Capital to be a Global Ventures, and it's not a it's not a space tech VC, but we have both like more as I call it easy tech solutions, as well as deep tech solution investments. And for the last 6 years, I've been running the project Task VC, sharing my knowledge about space, about my like how investors making the decisions, as well as for the last 3 years, I've been co-founder of Space Ambition. It's a number one Substack blog where we share knowledge about space tech deals, how space tech investment are made, etc. Feel free to subscribe. This is a QR code. Feel free to subscribe to me on LinkedIn, where I post more information. For example, today I've published an article about how I ended up working in venture capital and how my aerospace engineering background helped me in this journey. Yeah, and a couple of words about I2BF, where I work. So it's the fund is for 20 years on the market, more than $400 million under management. We closed more than 200 deals, and we have public companies. We have unicorns in our portfolio. We have co-investments with top VCs. Yeah, and this lecture was first read was done for Barcelona for my lecture offline event in Barcelona. So this is why you see here the Sagrada Familia. And yeah, let's talk about some statistics first. About 90% of startups fail. Even more, about 75% of venture-backed startups fail. So raising money is not, is not a success. It's more like a commitment. And if you look at the statistics of statistics of for companies which uh, raised various funding, the chances of the chances to go bankrupt are really high for pre-seed and seed companies, and only after Series A this risk significantly goes down. And here you like after Series A, you're most like your base case scenario. It's either you grow fast or you can your upside doesn't work out, but the company still continuous operate. Then, if we talk about the reasons why startup fails, and I here take the statistics from CB Insights, about 70% of the startups, close because of because of the shortage of the capital. But ironically, it's not the main reason. While statistically it is so, it's more like a consequence of other reasons. Because you run out of money, it means that investors don't believe in you any longer, but they don't believe because of the business reasons. So, and first and biggest reason why you fail is you have a poor product market fit. So you're doing essentially some solution which doesn't have a big need from the clients. The second reason why you fail is the wrong timing, and oftentimes it happens that a startup is too early on the market. For example, when I started working in venture capital in 2014, our fund invested in Planetary Resources. It was a company which was going to mine asteroids. So it was like the previous iteration that slipped my mind. Another company, Starforge. And it was a decade ago. It was too early and didn't play out well. So the second reason why oftentimes startups fail is because they have a wrong market timing and market conditions. And and the third reason why startup fails is unsustainable unit economics, and especially when it comes to deep tech companies, oftentimes you don't think it through, and the economics like doesn't work really well for your company. Now, I wanted to, before we move forward and I tell you about the main parameters we as VCs looking into, I wanted to show several reasons of systematic like thinking lines of thinking for the startup founders, which lead to poor outcomes. So the first thing which I see a lot, especially when it comes to deep tech founders, and especially for space tech founders, you significantly overestimate the real size, but the real potential of the business which you're going to build. Uh, I know that like McKinsey and others pitch that space will be a $1.8 trillion dollar economy, but it's spread across wide spectrum of niches, and in many niches, when you carefully look into them, you see that they are way below $1 billion in market size. And $1 billion is a magic number which most of the VCs are pursuing because having a size of $1 billion or more will secure that your company will be will be a multi-billion dollar company. So, first recommendation here is make sure that your market is big enough. The second thing is there are some founders which would like to develop their businesses exclusively using their own funds or grants. For deep tech companies, it's not oftentimes it's not available just because you even to build a prototype you need a lot of resources because you first develop a technology and then you put it on the market. But for the more easy type of businesses like software businesses, sometimes founders would like to go without raising funding. And that could be a problem because if you don't raise funding, yeah, you're okay. But if the market is big enough and your competitors will raise funding, then you will be moving slower than them, and you will lose your market share because the company with the funding will be aggressively promoting themselves and grasping the market share. The second mistake, which oftentimes happens, and it happens often with deep tech founders, is choosing their own partner. And we oftentimes fall in love with CVs of good founders, but finding a co-founder is not only about the skills. It's about the commitment, it's about chemistry between you two, and it's about mission, it's about how you stick together and if you can if you collaborate as a team. So if you are looking for a co-founder, and for deep tech founders, typically business co-founders are missing. So before you rush into the partnership and grant a big share to the co-founder, spend some time working with this person, understanding if you are a good fit before you become a co-founders. The first trap, especially it happens for businesses outside the US, is that you're building a business with a focus on your local market, and then and your local market is very small, and you think that yes, I will like during the next couple of years I'll be building a solution for my local market, and then I will expand to the US. But this is you could experience problem especially when if you build a B2B solution, because your local market could be different from the market, for example, bigger market, for example, US market, and you will build a solution which wouldn't have like a lot of needs on the US market, for example, and you will need to reinvent the product. While your competitors, which already operate in the markets, or the US markets, they will be developing their solution. And yeah, so if you want to build, if you plan to build for the big market like US market or some other markets, start testing your solution as early as possible on this market. And the second reason for that is for smaller countries with smaller startup ecosystems, you can hardly raise like seed and pre-seed and seeds from your local ecosystem, while raising Series B, A, Bs, and beyond will be on, for example, in the United States. And to get money from the US VCs, you will need to show the traction on the US market. So the sooner you start building business on your target market, the better. And the fifth factor I would like to stress on, and we will talk a bit later more about it, is ignoring the competition. I mean, and in many so why so first of all, we as VCs were built to invest in companies who have like about a dozen of competitors. But what we want to what situation we want to avoid is to invest in companies which have very low barriers to entry and could be easy to replicate. And why? Because it eventually leads to very thin margins. And with deep tech founders, with deep tech solutions, you have naturally those technological barriers, because it's not easy to replicate the technology. But even with such technologies, you can end up in a very competitive landscape. For example, you have a couple of weeks ago, I have considered the case of Rocket Lab, and in this case, we looked at how Bessemer made this decision. And at the date of the decision, the competition was really low, and Bessemer saw that Rocket Lab has had about 2 years of as a first mover advantage. But in the long run, the company will experience more fierce competition, just because it was not hard, actually that hard for the end users which launch their payloads to switch from one provider to another, and they didn't actually care. The only thing they cared was the price and the orbit where they could that they could reach with this provider. So they expected that in the future the competition will grow, and they and later we had about 120 companies which are doing like one way or another the launch in businesses. And we have a category leader, SpaceX. We have Rocket Lab with the small launch businesses. We have some other players, but yeah, but this what could happen. Like the technology only couldn't be not the only barrier. Yeah, and if you talk about like why early stage startups fail, first, it could be like it takes you too long to enter the market. You too much focused on doing something in the lab before you test and start real sales, and or at least get feedback. The other reason is like you're getting it takes you too long to get a feedback from the market. And what I really believe, what I see many deep tech founders saying, they say, okay, this, first I need to build the tech, and then I can, start talking to the clients. But it's not the case. For example, I've looked into a number of quantum computing startups, and quantum computers are not still at the stage where you could easily use it for your purposes. But still, they started from quantum-inspired algorithms and were selling R&D contracts for millions of dollars to big corporations to make them quantum ready. So the sooner you start getting the feedback from the potential clients, even you don't have if you don't have a product yet, the better. And the last but not the least, especially with deep tech founders, you can fall in love too much with your product or with your solution or with your technology, while sometimes you need to make a step back and decide to do something different or use an alternative technology, probably which is not that advanced, but which serves the purpose of your client. For example, we once invested in a company which was doing a solution for marine fleet. And they initially wanted to do a predictive maintenance solution. But when they started talking to the clients were answering that, constantly saying, before getting those predictive maintenance, we essentially need the data, all data collected in one place. So we need an API to collect those data, and we are good with that. Sometimes you are too early with your to the market with your solution, and they need to solve you to solve another problem first. So yeah, as a result, startups spend too much time building too little, very low interaction, and it leads to poor fundraising, etc., etc. Now, I wanted to give and to help avoid those problems. What I started to do is I provide some in various formats, advisory, consultancy to the startup founders. And I wanted to give an example of a startup founder which was operating in the field of AI solution for medicine, and they were targeting the MENA market. So they had pretty experienced founders. First they launched this business prior to COVID, and it was too early. And during the COVID they closed it. And then, in 2026, they decided to restart this business. And this time, before even given that the founders have 20-year experience, operational business experience in the field, which where they were going to launch a business, they were just picking a new geography and a slightly different solution with modern stack of AI stack. So we started from conducting a thorough market analysis and competitor research. Then we talked to a few early stage VCs which could invest like 6 to 12 months later in their endeavor to get the feedback, to see the blind spots. Then we also defined kind of the blind spots and the shortcomings they had in the team. And then I even helped them to hire an experienced CDO. So I sourced about 40 candidates for potential co-founders, and they eventually hired a guy, and now they're building an MVP and launching with first clinics. So good luck to them. Yeah, so this is the example how we can work differently with your product, with your solution, with the go-to-market from day one. Of course, when we talk about how investor makes decision, yeah, like it's a pretty sophisticated process, and I have a framework where I evaluate about 20 criteria. So unfortunately, I can't tell you all the framework in 1 hour. So I decided to show you like five key criterias which you need to know about. So the first criteria is essentially to be in the right place in the right time. So I see many founders, they pick like first-time founders, they choose idea randomly, and they don't even think about the investment strategy, how big is the opportunity, etc., etc. While experienced founders, before they take a risk and start building a business, they do a thorough research, talk to experts, and understand if there is a need, if they can raise funding. And ironically, sometimes the niches are not open to fundraising, not because like there is not a big need, but because investors invested a couple of years ago, lost a lot of money, and then they are scared from investing in this niche. So, for example, such things happened with 3D printing, with VR, with drones, because the first wave was around 2014 when I started working in venture capital. Then those industries were like for decades in oblivion, raising like they were no, the industry was developing, but it was really hard to raise funding from VCs. Another thing VCs look into, especially at the very early stage, and especially this is relevant for deep tech VC startups, is the team. And To build a good startup, of course, you need to have an experienced technical team, experienced experts in the field, but you also need a hustler. You need a sales person who will be building business, who will be raising tons of money. I strongly encourage you to identify your strengths and weaknesses and come up with a plan how you could fill in the gaps which you have in the team, either hiring an advisor or hiring a co-founder or hiring a person, a C-level manager. The third criteria we look into, and I already started talking about it, is the market size. And what I see people with technical backgrounds do now, they go to Google or they ask Perplexity, like, what is the market size for this, or work it is the market size for that. Then they find a random number, like, okay, the global market size, forecasted market size for quantum computing is like $20 billion in 5 years. Okay, I put this number and forget about it. But the reality is that you address only a small portion with your solution. You typically address a small portion of the market, and it's better to do a reasonable bottom-up calculations, multiplying the number of potential clients who can physically who you could physically who exist, multiplying it, but a reasonable check those clients are open to pay. Because I'll give you an example. When I started in venture capital, I considered a medical device company out of the US, and they were doing a solution for surgeries. So essentially they did a pan like this size, and this pan was you were using it during the surgery to identify if the tissue has cancer cells or not, and cut it off. So a very useful solution, very positive feedbacks from clients, immense need. But when you calculate the market size, it like I landed on the market size like less than $100 million globally, and it ended up that company couldn't raise funding. So do your calculation of the market, because we as VCs look at it the following way. Okay, if the market size is $100 million, it means that you can build a company with $10 to $20 million in annual revenue. And okay, if even like multiple to sales will be 5 or 10x, so we can sell this company for 100 up to 200 millions of dollars. And then we assess like if it's enough, is if it will provide us necessary returns or not. So this is why the market sizing is important. And the fourth parameter, which is really important, is a competitive environment, and not only the environment but the mode. Like why it's not easy to replicate your solution in the future. Why your clients wouldn't be switching easily from one provider to another. How you protect your market share, and why is it important? Engineers don't know economics, but if you go into economic concept, this when the barriers to entry are low, and everyone could launch exactly the same solution, you're in the perfect competition. And with perfect competition, the problem is that you have very thin margins, and if someone shows that there is a market, then more people rush into that, and this is actually what happens now with many solutions which are built with AI, because like it's extremely easy to build some sort of solutions like CRM, and many people try it, and as a result of it, the customer acquisition growth source, and you can't earn money. So this is a very important question, and the question states the following: it doesn't mean yeah, okay, you're now doing an MVP, you're now doing a small solution, yeah, you like probably it could be replicated, but what you will do in the future, like on a horizon of 1 2 3 years, to make this differentiation better, to make this barrier harder, to make your client sticker, this is the question we want you to answer. And the last but not the least, why like many founders underestimate the timing. So you need to answer why now is the right moment. Why 5 years ago or 3 years ago it was too early to launch your business, while in 2 years it will be too late to launch your business. Because I've been on the market for quite a while, and I've seen that early stage startups as a startup at the early stage, you don't have enough resources to create a market. And I've seen big companies like Microsoft or IBM building the markets. So they spend hundreds of millions of dollars and years to build markets around AI, for example. And you, as a small company, you don't have those resources. So this is why you need to answer what trends are now in place which are pushing the adoption of your solution. And these are not only technological trends. Oftentimes, these are the trends like regulation, like changing economical environment, and something like that. Yeah, so make sure that you understand what drives the adoption of your solution right now. Otherwise, you can end up in a business which is too early for the market, and you will run out of the resources before the market emerges. So these are the main. Yeah, one only. I wouldn't go into that details. So I believe we stop here. I will again get back to my contacts, and feel free to and we'll have about like 10 minutes for the questions, so feel free to ask your questions, and I will be happy to answer them. Nice presentation. I teach similar at Cornell Business School and a few accelerators and incubators. Ken, I would be happy to make a call later on. Probably we can discuss how we could collaborate. Any other questions? And before you leave, um, if you plan raise funding for your startup, or the horizon of 6 to 12 months, please feel free to reach out to me. Here is my here is my here is my email. We are planning to do an initiative which will help you to prepare for the fundraising. And if you plan to apply to Y Combinator, also feel free to reach out to me, because we will be helping to fill in the application forms, which the deadline is end of July. Okay, the question, Jimmy, do you see big difference between space tech startups versus SaaS startups in terms of reasons for failure? Of course, with deep tech startups, this underfunding becomes much like becomes even a bigger factor, because SaaS startups, they can if they don't raise enough funding, they just become a bootstrapped companies and exist. While with deep tech, it typically takes you to 2 or 3 rounds before you can earn anything. And when it comes to early stage funding, yeah, the situation that you need to build tech before you can start earning money is more pressing for deep tech founders. And the other problem is also associated with the fundraising is that there are so many VCs which could invest in SaaS, but the number of VCs which understand deep tech, not space tech, but just general deep tech, is much lower. So it's harder for you to raise funding. And as the time goes, for pre-seed and seed and Series A's, you typically have deep tech VCs which could support you, while Series A, Series B's, and beyond, you will be raising from generalist investors which don't understand anything about space tech or deep tech. And this is essentially why we're doing Space Ambition and why we're doing the webinars like that. We just want to educate people and help them to understand how make informed decisions about those technologies. Yeah, now Frank asks, what is your view on the milestones set by the company? How do you validate those and determine if there is enough money to achieve those? So, if we talk about uh, okay, for any type of investor, especially like at the early stage, you look at the startups which like you more or less understand the sphere it operates in, and you have historically seen other companies go in the same direction. If it's a SaaS company, there are so many playbooks and like magic numbers you look at, and you understand like whether the forecasts are too optimistic or more realistic, etc. If we talk about the deep tech, so you either have in-house a person who can assess the risks and the timing for implementing some technologies, or you hire outsourced consultants to which can go through the risks and assess how reasonable the timeline you're showing or not. And I strongly encourage you to watch my previous webinar about Rocket Lab, where because we specifically stressed on this because Bessemer in that webinar I show that Bessemer hired an R&D consultant. They were closing a Series B, and this R&D consultant assessed the timeline, the bottlenecks, and the associated technological risks and schedule for rolling up commercial applications to understand whether it's reasonable or it's super optimistic and what problems should arise. I hope did I answer to your question, Frank? Does anyone have any other questions? So if none of you have questions, like we can wrap it up in a minute. If you have questions, please drop them in the comments. And again, as I say, like this webinar is just the beginning of the journey. If you're doing a business, you need an advice, you shoot me an email and we can discuss. If you're a VC, a business angel, or an advisor, and you see the ideas how we can collaborate, you shoot me an email, you make a suggestion. I was a little bit busy in June, and July seems a little bit less busy for me. So I will be happy to talk to you. I will be happy to discuss collaborations. So just be creative, provide your ideas. Yeah, and if you plan to apply to an accelerator like Y Combinator or social CDL or some others, and you need an overview of what your like of your application, you shoot me an email and we can discuss. So if none of you have any other questions, let's wrap it up for today. Thank you for joining the webinar, and I hope this webinar will be useful for you to, and I wish you to succeed in building your business, investing in startups, or building ecosystem for developing deep tech startups. Well, thank you for joining. Have a great day. Bye bye.